Hey everybody, Nicole Johnson with CoVision Real Estate Group, and today's frequently asked question is, what is a loan modification? A loan modification is a change to the already existing promissory note and deed of trust and the terms of the loan and the agreement to pay it back. A loan modification typically happens if a borrower becomes in distress. So something's happened in their life where they're unable to make payments. And typically, a loan modification is when they're unable to make payments for a certain period of time, but they've been able to get back on their feet. They're able to start paying again. Rather than facing foreclosure, they'll reach out to you, the lender, or actually the servicing company. And there's some interaction and communication to try and figure out, okay, why has the borrower stopped paying? And are they able to get back on their feet again? What's preventing them from stopping? And so it's figuring out what that borrower's problems are and what their needs are, and can they make payments. So a loan modification, some are, okay, they had medical issues and couldn't pay their mortgage for 4 months, but now they're back on their feet again. They have their steady income, they can make their payments again, but they don't have the money to make up those 4 months of missed payments. So rather than foreclosing and kicking them out and starting the whole process again, what you can do is a loan modification and say, okay, let's start it from here, but we're going to adjust the terms of the loan. We're going to take those 4 missed payments and we're just going to add them and extend the life of the loan by 4 extra months at the end. And so rather than stopping in January 1st of 2027, they'll now stop on April 1st of 2027. So they're just making up those payments at the end of the loan. So you go through something of a loan modification and create new paperwork that documents this change to help keep the borrower in the house and making payments again, but also making sure that you're not just losing those monthly payments that you're entitled to. So you can work with the borrower. You're going to work with a loan servicing company to just modify that loan if it's suitable for the situation, and if the borrower is able to continue to pay once more and they're back on their feet. You can modify it to help keep everybody happy again. You can also extend the life of the loan. You can change those terms, but obviously everybody has to be in agreement, and it gets recorded against the property, and the new terms go into place. So that's one of those things. It's super rare. Honestly, it doesn't happen very much. We've maybe only done it once or twice in the 50 plus notes that we've owned over the last 4.5 years. So super rare, but still just something to know and something interesting about it. It's a way to protect your investment, keep the borrower paying, get them back on their feet, and also help protect your investment and keep them paying. So if you have any questions, feel free to reach out, give me a call. Always happy to chat and talk about this topic. We love talking about real estate investing and especially mortgage notes. So hope you enjoyed this video and have a great day. Thanks, bye.